Almost every listed company worldwide uses the indirect method for its operating cash flows. Yet IAS 7 explicitly encourages the direct method. That tension is worth unpacking. In this episode, we will cover both methods mechanically, reconcile them to exactly the same number, and flag the judgment calls that trip up even experienced preparers. IAS 7 governs the statement of cash flows. It requires cash flows to be split across three activities: operating, investing, and financing. The investing and financing sections are always presented the same way under both methods. The choice only affects how you present operating activities. That is a point candidates frequently miss. The indirect method starts with profit before tax, or profit after tax in some jurisdictions, and then adjusts for non-cash items and changes in working capital. The direct method instead shows the actual gross cash receipts from customers, gross cash paid to suppliers and employees, and so on. Both routes arrive at net cash from operating activities. Think of indirect as working backwards from the income statement, direct as reconstructing the cash ledger from scratch. Let us set up a worked example we will carry through both methods. Nexus Manufacturing has profit before tax of $420,000. Depreciation is $90,000. Trade receivables increased by $30,000. Inventory decreased by $15,000. And trade payables increased by $20,000. Tax paid in the year was $80,000. Income tax expense was $100,000. So there is a movement in the tax liability. Here is the indirect method presentation. We start at profit before tax, add back depreciation because it is a non-cash charge, then apply the working capital movements. Receivables up means cash collected was less than revenue, so we deduct $30,000. Inventory down means less cash was tied up. Add $15,000. Payables up means we owe more than we paid. Add $20,000. That gives us cash generated from operations of $515,000. Subtract tax paid of $80,000 for net cash from operating activities of $435,000. Now let us reach the same $435,000 using the direct method. We are given that revenue was $1.2 million and cost of sales was $600,000 with the relevant working capital movements. Cash collected from customers equals revenue less the increase in receivables. 1.2 million minus 30,000 equals 1.17 million. Cash paid to suppliers equals cost of sales, adjusted for inventory and payables movements. Operating expenses paid and tax paid complete the picture. The final line is identical, 435,000. It helps to see the indirect method as a T-account reconciliation in disguise. The movement in each working capital account bridges the income statement accrual to the actual cash movement. Here you can see how the receivables T-account translates. Opening balance plus revenue less closing balance equals cash collected. Exactly what the direct method line shows. So if both methods produce the same number, why does it matter which you use? Information quality. The direct method exposes gross receipts and payments. Analysts can see the actual cash conversion cycle. The indirect method obscures this behind adjustments. IAS 7 paragraph 18 says the direct method provides information useful to estimate future cash flows that the indirect method does not provide. That is a strong statement from the standard. IFRS 18, which supersedes IAS 1 and is effective from January 2027, does not change the IAS 7 method choice, but does refine how certain items flow into operating profit. So watch this space. When an entity uses the direct method, IAS 7 paragraph 20 requires a reconciliation of profit or loss to operating cash flows, essentially the indirect method, as a note disclosure. So direct method preparers must produce both presentations anyway. That is the main practical reason why entities default to indirect. You do all that work and still have to show the reconciliation. If you are going to produce both, preparers argue, just present the indirect method directly in the face of the statement. Interest and dividends are a perennial classification minefield. IAS 7 offers policy choices. Interest paid can be operating or financing. Interest received and dividends received can be operating or investing. Dividends paid can be operating or financing. The entity must choose a policy and apply it consistently. Financial institutions typically classify interest paid and received as operating. Non-financial entities more commonly put interest paid in financing and dividends paid in financing. But there is no single right answer, and comparability across entities suffers as a result. Here is a bar chart showing how the depreciation add-back in the indirect method can dominate the adjustments, particularly in capital-intensive businesses. Nexus Manufacturing's add-back of $90,000 represents 21% of profit before tax. In a capital-intensive entity, that ratio might exceed 100%, meaning operating cash flow materially exceeds reported profit. This is why analysts watch cash conversion ratios closely, and why the indirect method's reconciliation is genuinely useful despite its limitations. 3 common errors to watch for. First, netting cash flows. IAS 7.22 prohibits grossing up being bypassed except in specific circumstances like rapid turnover, large amounts, and short maturities. Second, including non-cash investing transactions, like acquiring an asset under a lease, in the cash flow statement. These belong in a supplementary disclosure only. Third, misclassifying bank overdrafts. They form part of cash and cash equivalents only if they are repayable on demand and integral to the entity's cash management, not just any overdraft facility. To summarize the key points, both methods produce identical net cash from operating activities. They are algebraically equivalent. The direct method gives richer information but requires more data, and still requires the indirect reconciliation note. The indirect method dominates in practice purely for cost and convenience reasons, not because it is superior. Classification of interest and dividends involves genuine policy choices. Document and disclose them. And as IFRS 18 beds in from 2027, the definition of what sits in operating profit will tighten. So revisit your cash flow classification policies then.